Well, we've certainly got some big news for you today. The Westpac Melbourne Institute Index of Consumer Sentiment fell by 5.6% to 90.8. That's the lowest level we've seen since August 2020, which of course coincided with the second close down in Victoria. The size of the fall was quite extraordinary. Obviously, we saw bigger falls during the COVID period, but apart from that, we haven't seen a fall like that since 2015, when the European financial system was under great pressure and the Chinese economy was slowing down, and that was reflected in a very sharp fall in the global share markets. And before that, of course, we had the horror 2014 budget, when we saw a fall in confidence of 6.8%. So why did this fall happen? Well, clearly there's been two stunning events since the last survey. And the first one was the announcement that inflation in Australia had reached 5%. We hadn't been near that level since 2008. The second one, of course, was the decision by the Reserve Bank to raise interest rates for the first time since 2010. That decision, in fact, really unnerved households. A month before, 34% of households expected that interest rates would go up by more than 1%. That number jumped to 52% following the announcement by the Reserve Bank. There were some interesting developments in some of the components of the index. We saw an 11.2% fall in how people see their finances going out the next 12 months, and a substantial fall once again in the decision about whether now is a good time to buy a major household item. That index is now 27% below its long-term average, meaning that the rise in inflation is really dissuading people from buying major items. We also saw a substantial contraction in confidence around the labour market. More than a 10% fall in confidence there. It's still a very strong number. It's still well ahead of the long run average, but it was quite a shock to see people even feeling a little nervous around the labour market. But of course the big story was around housing. Time to buy a house was now down by more than 40%. It fell by 1.5% in this survey, but it's already down 40% from its peak since November 2020. But more interestingly is that we saw a 9.4% fall in the index of the outlook for house prices. That index has been incredibly strong. It's still at 121. It's still above that 100 level, so we still have a majority of people expecting house prices to rise. But the tumble we've seen in the last few months means that people are really starting to get more realistic about the outlook for house prices. As you know, Westpac expects the peak to trough fall in house prices between the middle of 2022 and the first quarter of 2024 being around 14%. That 121.2, well above 100, but the numbers are much lower in New South Wales and Victoria. So the Reserve Bank meets on the 7th of June to make its next decision on interest rates, and we can be almost certain that there'll be another rate increase. The debate is about by how much. Analysts are expecting the rate increase to be 25 basis points, which was the inclination given the comments from the Governor at his press conference where he talked about business as usual. But from my perspective, it should not be business as usual. Over the last month, the Reserve Bank has had to raise its forecast for inflation substantially. In fact, since February, the inflation forecast has been increased for this year from 2.75% to 4.75% for underlying inflation. They now expect that inflation will fall to 3% by the middle of 2024. Cutting it from 4.75% to 3% is going to be a major challenge. And I don't think it should be business as usual in order to achieve that objective. The better policy would be to have a larger increase early on in the cycle so that the risk of pushing rates too far is minimised. The earlier on you have a larger increase, the less likely it is that you'll go beyond that inflection point where policy becomes too contractionary. So I'm expecting that the better policy would be to lift rates by 40 basis points. That would mean a total increase over the 2 months, May and June, of 65 basis points, which was exactly the reduction in rates we saw during the emergency period of 2020. Let's start after June, where at least we've reversed those emergency cuts and move forward to what I think will be around about 1.75% total increase in rates by the end of the year, and about 2.25% in total by about the middle of 2023. But there's a high degree of uncertainty around this. The most important point, of course, is that the Reserve Bank needs to remain on that track of dealing with these inflation risks, containing inflationary expectations. And despite the fact that we've seen this big fall in confidence today, the Reserve Bank should not be diverted from those objectives. Thank you very much.